Hello, my name is Desiree Elias. I am the Assistant Controller at FIU. Today we'll be continuing the Budgeting 101 section on accounting review. Specifically, we're going to talk about revenues, expenses, and cash transfer concepts. Revenues. Remember, revenues are monies coming in. We have two general types of revenues. Operating revenues, which are generated from providing goods and services to our customers in the normal course of operations. And we have non-operating revenues. An example there would be interest income that we make on our excess cash. Most of you, though, will be exposed to operating revenues. Let's talk about some examples. So here, what types of monies do we earn? We have tuition and taxes that the state gives us. We have other student fees such as lab fees, parking, housing. We have sales of goods or services. An example here would be if we hold a conference or seminar and we actually charge a fee to have people attend that conference or seminar. We also receive monies from federal and state agencies to do research. We call these grants. And then we also receive donations for charitable purposes. Those are tracked through the FIU Foundation. These are examples of operating revenues. You will notice that each one of these is tied to a specific source. Each one of these represents a funding source, and in fund accounting we must segregate activities by funding source. So for example, tuition and state taxes are tracked in an ENG fund. Student fees and sales of goods or services are mostly auxiliary funds. Grant revenues are contracts and grant funds. And then donations are tracked specifically through the foundation. Note that there are other types of revenues. This is just a very small list. Now in fund accounting, revenues are recognized when measurable and available to spend. Basically, the earlier of when you collect the revenue in cash or when you've earned it, if you have not yet collected it. When do we earn revenue? We earn revenue when we have actually provided the good or service, when we have a claim against a customer for payment. Now, what is the effect of revenues on our financial position? Remember, accounting tracks two things: the performance of operations on one side and the resulting effect on financial position on the other. So our revenues affect our financial position by creating receivables if we have not yet received the revenues in cash, not yet collected the revenues in cash. So we will have an accounts receivable from a student up until he or she pays off that account, the amount that they owe us. That is the effect on the financial position. Expenditures. Expenditures are monies going out the door. Monies that are being spent that help us actually generate revenue. Now, for those of you that are familiar with financial accounting concepts, there's two ways to treat expenditures. If we have already received the benefit, if we are making a payment for a good or service, and we've already received the benefit of that payment, we are going to expense those costs immediately. Here, examples would be salaries, travel, supplies, utilities, those type of items. Now, if when we make this payment, we're actually acquiring something that has a long-term benefit. An example would be a piece of equipment, for example, that we plan to use for a long period of time. In the financial accounting world, we would capitalize that payment. Here at FIU, we refer to these type of items as OCO, other capital outlay. Other capital outlay are payments greater than $5,000 for things that will provide a long-term benefit. Again, an example would be, let's say, a piece of lab equipment, a very expensive piece of lab equipment. These are other capital outlays, or OCO. Now, let's talk about fund accounting and how it differs from financial accounting. In fund accounting, all expenditures for goods or services are recorded in the period that they occur using accrual accounting. Now, we will illustrate, or I will illustrate, accrual accounting a little bit later in the third section of this accounting review presentation. But just a reminder, accrual accounting is when you recognize an expense regardless of when it's paid for in cash. When you actually incur the expense, that is when you recognize it. Now, at the operating fund level, again, back in fund accounting, all expenditures are treated as expenses, and those subject to capitalization are accounted for in a different fund. Now, really, what does this mean? Let's use the example of the lab equipment. If we purchase this lab equipment for over $5,000, that purchase is classified as OCO immediately, which is an expense. If I'm looking at a report of my operations for a certain period, I'm going to have revenues as inflows. I'm going to have expenses as outflows. Part of those expenses is going to be this OCO item. Now, what will happen is the controller's office then, in another fund, in a separate fund, will reverse that OCO and will reclassify it as a capital asset, and then they will depreciate it during the life of the asset. If we believe that this lab equipment has a 5-year life, we will reclassify it and then depreciate it over 5 years. Most of you will not have to worry about that side of it. That is the non-operating side. Most of you only deal with the operating level of activities here within the university. However, I did want to bring it to your attention. If you're someone familiar with financial accounting and you come here to FIU, you might look at the fund accounting reports and question why we're expensing long-lived assets and not recording depreciation. We do, we just do it somewhere else. Okay, let's talk about, again, what is the effect of expenses on our financial position. Expenses that have not been paid are classified as payables until they've been paid in cash by us, by FIU. This is the other side of the receivable. In the receivable side, we have a claim against a customer or a student. On the payable side, we're on the other side. A vendor has a claim against us. An example here would be invoices from vendors with certain credit terms. We purchase something from a vendor, but we don't have to pay right away. They allow us to pay, let's say, in 15 days or 30 days. During that time, it is a payable that we have to the vendor. That is the effect on our financial position. Now, this slide gives you the sources of different revenues and expenses. When you look at a report, let's say you want to do a little bit of investigation of what some of these revenues and expenses are and where they're coming from. Things like tuition or other student fees are billed through our student financial system. The student financial system houses all the charges to our students. Other things, such as credit card deposits or actual cash deposits, are coming from the cashier's office. On the expense side, you have the payroll or the HR system, which captures salaries and benefits. We have vouchers, which are used to process checks. That is for operating and capital expenses. You can also purchase something using a Pro card, which is basically a university credit card. Also, you can have a situation where one department within FIU actually bills another department for services. An example here would be phone lines. Our UTS department charges other departments within the university for having a phone line. That is an interdepartmental charge that does not require any type of approval. UTS goes ahead and processes the charges every month with no approval. However, sometimes approval is required. An example here would be facilities maintenance. If you require a facilities person to come out to your office to do some work, that facilities, after they do the work, they will charge the department for the work, and the department that requested the work has to also approve it. So there's approval on both sides. Regardless, in both cases, reclasses of revenues and expenses from one department to another should be processed using the smart billing system or an interdepartmental transfer form. In limited cases, that is sent to the controller's office. Finally, in this section, let's talk about cash transfers. There's always a little bit of confusion of when something is an expense or a revenue, or when something is a cash transfer in or out. Cash transfers are what we refer to when we're using cash that's generated in one department to fund activities or to subsidize activities in another department. And the best way to talk about this is through a couple of examples. Let's say that FIU Online receives distance learning fees from our students who are registered in online courses. The costs to run the operations of FIU Online are recorded in the FIU Online department. But there's some other costs that are incurred in the departments and specific academic units. FIU Online will transfer out a portion of those fees to other departments to help them fund their activities. Another example would be, let's say, cash for construction. Parking contributes $5 million to construction to build parking lot 5. That is a transfer out from construction. Finally, let's talk about creation of new activities. Let's say a unit, an academic unit, creates a new auxiliary and they need to have some startup funding to be able to pay for expenses immediately. So they're able to have another activity give a short-term startup loan to the new department, and once the new department can, they will pay back the loan. It's like a short-term loan. Those are done as cash transfers out from one department, and then eventually cash transfers back in once the new department has generated enough income. Now, cash transfers out of one department are cash transfers in to the other. Transfers out from the contributing department are transfers in to the receiving department. And this is done using a cash transfer request form. By the way, these forms can be found in the controller's website. Keep in mind that cash transfers out are not expenses. Cash transfers in are not revenues. Expenses and revenues refer to operating activities. Activities on a day-to-day basis that occur for our operations. These things that we've talked about are things beyond that. Things out of the normal operations. That concludes today's discussion on revenue, expense, and cash transfer concepts. In the next section, we're going to be putting all of this together, the things that we've talked about in the last two sections, by showing you an example of actual events and transactions that occur in FIU and how we account for it. Thank you for your time. Have a nice day.